Hey guys, it is Julie here with TipRanks, and today we're taking a look at 3 perfect 10 stocks to buy and hold for the long term. So let's get into it. Alright guys, welcome back. Thank you all so much for being here. I hope you had a lovely long weekend. Today we're taking a look at 3 stocks that score a 10 out of 10 on the TipRanks Smart Score. This looks at 8 unique factors and measures a stock's likelihood to outperform the overall market. Now these stocks have a long history of profitability and growth, and on top of these 10 out of 10 ratings, they also come in with a strong buy consensus from Wall Street analysts. So today we're going to take a look at these companies, what it is that they do, and what those analysts are predicting for the stock's future. We found these companies using the TipRanks Stock Screener. Found right at the top of the Research Tools menu, with the Stock Screener, we looked for a 10 out of 10 on the Smart Score, an upside potential of 5% or higher, and a strong buy consensus from Wall Street to narrow down our list below. Just before we get into today's stocks, this is a friendly reminder that if you enjoyed today's video, make sure you hit that thumbs up button and that you're subscribed to the channel as well. Now let's get right into our 3 10 out of 10 stocks. First on the list is the Royal Bank of Canada. They trade under the ticker RY, currently priced just shy of $121, recently hitting new record highs. The stock has climbed over 41% in the past year and gained another 13.5% in the last 3 months. They score a 10 out of 10 on the TipRanks Smart Score with increased hedge fund activity, bullish blogger sentiment, and positive technicals and fundamentals. The Royal Bank is actually one of the largest banks in both Canada and around the world. They've been providing financial services for more than 150 years and are now one of North America's leading diversified financial services companies, providing personal and commercial banking, wealth management, insurance, investor services, and capital market products and services on a global basis. The Royal Bank is a well-known dividend company as well, having started paying out a dividend back in 1870. Over the last 10 years, their dividend growth rate is nearly 6%. And they just recently declared their latest quarterly dividend, coming in at $1.42 per share, putting their yield above 3.5%. Their next ex-dividend date is October 24th for payment on November 22nd. And they announced that dividend news the same day as their third quarter earnings report, where the bank did come out with a notable earnings beat. For their Q3, they reported earnings per share of $2.42, coming in comfortably ahead of the $2.19 expected. Net income grew 16% year-over-year, coming in at $4.5 billion. And following that Q3 earnings report, we've had a handful of Wall Street analysts weighing in, with the majority of them increasing their price targets, including one 5-star analyst from Argus Research. They noted that the Royal Bank's merger integration with HSBC has already yielded $120 million of cost synergies and is on track for an expected total of $740 million. The Royal Bank remains in a strong competitive position with a growing market share in Canadian banking and a solid wealth management franchise. The stock does come in as a strong buy based on 11 buy ratings and 2 holds. And the average price target comes in at $122, which would only be a slight upside of about 1.5% after all that recent stock growth, so maybe a good one to wait for a bit of a pullback on. But when we look down at some of the more recent price targets, we do have some with some more notable upside. Our high-end price target comes in with an upside of nearly 13%, a couple around that 9 to 10%, while our low-end price target, we do have a hold with a downside of 8%. For our second 10 out of 10 stock, we're taking a look at Abbott Laboratories. They trade under the ticker ABT, currently priced at $114 per share. They've climbed 15.6% in the past year, and in the last 3 months have gained 11%. Their 10 out of 10 on the TipRanks Smart Score does come with increased hedge fund activity, very bullish new sentiment, and positive technicals. Abbott Laboratories offers a diversified line of healthcare products. Their goal is to create life-changing health technologies that help people live healthier lives, and they're focused on 4 different segments with medical devices, diagnostics, nutrition, and pharmaceuticals. Some of their products and services include removing the pain of finger sticks for people with diabetes, connecting patients with doctors through real-time information monitoring, and easy chronic pain and movement disorders. Abbott Laboratories has achieved Dividend King status, having paid and increased their dividend every year since 1972, and they also have an impressive dividend growth rate of over 11% for the past 5 years. Their most recent quarterly dividend was 55 cents for a dividend yield of 1.91%, and that was paid out a few weeks ago on August 15th. In mid-July, they shared their second quarter earnings report where they saw both an earnings and revenue beat and increased some future guidance. For their Q2, they reported earnings per share of $1.14, beating by 4 cents per share, while revenue came in at $10.4 billion, beating by $30 million and seeing organic sales growth of 9.3%. Looking forward for the full year, they increased their adjusted diluted earnings per share guidance and organic sales growth. Just a couple of weeks ago, we did have a 5-star analyst from Citi who reiterated their buy and increased their price target on the stock. Referring to the overall medical technology sector, the analyst called Q2 another wild ride, seeing that the earnings prints brought several eye-opening and frankly shocking deliveries, changes to guidance, and stock price reactions. They expect an interesting September broker season. With 14 current analyst ratings, Abbott Labs does come in as a strong buy with 11 buys and 3 holds. And the average price target of $127 would imply an upside potential of nearly 11%. Looking at those ratings down below, we can see our Citi analyst here with an upside of 11%, a couple on the high end at 143 for an upside of 25%, while our hold rating is our low-end price target with a downside of over 6%. If you've made it to our third stock today, then make sure you've hit that thumbs up button. Third on our list of 10 out of 10 stocks is Baker Hughes. They trade under the ticker BKR, currently priced just shy of $34 per share. Overall, in the past year, they are down 6%, but in the last 3 months have gained 7.8%. They score a 10 out of 10 on the TipRanks Smart Score with very positive crowd wisdom and increased hedge fund activity. Baker Hughes is an energy technology company and a longtime leader in the oil industry services niche. As an advanced industrial technology firm, they are working at both the development and deployment of the energy technology needed to maximize production and efficiency in the world's hydrocarbon production regions. They work with oil and natural gas producers as well as industrial firms to provide streamlined solutions for the development of clean and reliable energy. They're known for their leadership and solutions in the liquefied natural gas industry. And you might be picking up on something in common with these long-term stocks. We have yet another dividend payer. Baker Hughes has dividend payments dating back to 1989. In progress. And over the last 5 years has a dividend growth rate just shy of 3%. Their latest quarterly dividend was paid on August 16th at 21 cents per share for a dividend yield of 2.3%. Baker Hughes shared their Q2 earnings report on July 25th, coming out with both an earnings and revenue beat. Q2 earnings per share of 57 cents beat estimates by 8 cents per share, while their revenue of $7.1 billion also beat and grew 13% year over year. The company also saw record IET RPO, or Industrial Energy Technology, remaining performance obligations of $30.2 billion. And following that quarterly earnings report, one analyst that we heard from was a 5-star analyst at Jefferies. He reiterated his buy on the company, saying that they restructured their organization and appointed key leaders, leading to a more consistent operational and financial performance. Their strategic moves, spearheaded by their CEO, have been successful in renovating the leadership team and driving better results compared to the legacy organization's occasionally inconsistent performance. Baker Hughes has 17 current analyst ratings with 15 buys and 2 holds. That strong buy comes with an average price target of $43.47, implying an upside potential of 28%. And when we look at all of our ratings down below, they all have double-digit upside potential. Our high-end price target comes in at $50 for an upside of over 47%, while our low-end price target is $40 for an upside of nearly 18%. So that is a quick look at 3 10 out of 10 stocks with some long-term potential. Let me know your thoughts on these companies in the comments down below and what other stocks you're holding in your portfolio for the long haul. I always love hearing from you guys. Please keep in mind these videos are never a suggestion to buy or sell any specific stock, so make sure you always do your own research and due diligence. Thanks so much for watching. Have a wonderful day, and I'll see you back here next time.